Hey, it's Todd Ault, and welcome back to Wall Street Words. Today's word is bear market. Now, we don't want to talk about this word, so we're not going to give you a definition. Just kidding. So let's say you're part of an investment, you have money in the economy, you're invested in the stock market, and the market declines more than 20% over kind of a 2-month period and sustains that long-term drawdown in terms from peak to trough. It's widely defined that when you're in a 20% correction, you're in a bear market. I don't necessarily think the 20% rule is really that relevant, but generally equity prices are declining over time. Maybe the economy's pulled back. There was kind of a bear market in the 2008 timeframe when the housing bubble burst. These bear markets are prolonged declines of equity prices, but they can be individualized to individual stocks, commodities, generally things that are declining over a period of time. The economy has a big part of this, the Federal Reserve has a part of this, and this usually means that those stocks or bonds are unattractive and they're in a declining market. There's been lots of bear markets over the last 100 years. Some have been initiated by shocks in the economy, like the 1991, I believe it was 1991, when Iraq invaded Kuwait. But these bear markets can last 3 months, they can last 9 months, they can last a couple of years. Today's word is bear market, not my favorite word.
Hey, thanks for watching Wall Street Words. Please subscribe and hit that bell below. If you think this video adds value, please share it with somebody. By the way, if you want to watch more Wall Street Words videos, there's 2 videos right here you can watch right now. There's new videos every day. Thanks for watching Wall Street Words. Always great things happening here.